equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have our favorite financial advisor joining us in the studio, and we're going to pepper him with all of our questions.
That's it. It is our pleasure to welcome back Charlie Viola. Charlie, welcome.
Okay, gents, how are we?
We're very
good,
well.
very
How are
good.
you?
Yeah, all right. Happy New Year, I guess.
Yeah.
Is
Yes.
it still the New Year? It is.
Yeah, it is.
Yeah.
And happy new space. It's my first venture into your new offices.
What do you think?
Yeah, they're great.
Yeah,
I love the veranda and the
Yes.
view and stuff.
Did we have you back at the Batuta studio back in the day?
Yeah.
Yeah, I think
Yeah,
so.
yeah. You've been on the journey with us.
Yeah, that's right.
3 or 4 years ago. So we recognise that financial advice is expensive, with only 10% of Australians receiving advice. And throughout 2023, we want to try and do something about that with a series of episodes called Ask the Advisor, where we're going to bring on some of Australia's best advisors, giving you the opportunity to ask them questions. We'll be covering a range of topics, not just all about investing. And it starts today with Charlie. If you do want to ask a question for the advisors coming up throughout the year, the best place to do so will be the Facebook group. So we'll let you know which advisors are coming up, but we are super excited for this episode. If you haven't heard of Charlie before, firstly go and listen to the previous episodes we've done with him. But he is partner and managing director of wealth at Pitcher Partners, which manages $3.4 billion. Charlie is personally responsible for managing $2.2 billion of funds under management. No pressure, Charlie. That's a lot of money.
That's a lot of other people's money.
It is. He advises high net worth and ultra high net worth individuals, and has been recognised by Barrons as the number one advisor in Australia in 2018 and number 4 in 2019, and recognised multiple times as one of the top 50 most influential advisors here in Australia. So plenty of experience. And today, Ren, we're going to be unpacking 2 sort of key buckets. Firstly, portfolio construction, and then secondly, having a chat with Charlie about how he's advising some of the younger clients who are coming through with smaller amounts of money.
Yeah, or the children of clients.
Yeah.
And we hear that's a really common question in the Equity Mates community. Someone in the Equity Mates team actually has just had a kid. Congratulations, Simon and Kez. And he set up an investment account for his kids. So it's definitely a big question, and we're excited to hear how Charlie approaches that with his clients.
But and Bryce must be close too.
You absolutely
If
nailed
Harriet's
it.
listening, don't get any ideas.
I reckon by the end of this year, there'll be some news.
No way. We've got a business to run.
Hey, the business isn't going anywhere, but you are getting older. Anyway, Charlie, we'll take that offline. We want to start with portfolio construction because, you know, when risk is higher, having a well-constructed portfolio can be a really important step, an important defensive step in some respects. So I guess let's start at the very beginning. When you're speaking to your clients, what are some of the key principles of portfolio construction?
I think I've got a really simple philosophy on this stuff, and I think the 3 kind of main principles around constructing any portfolio are around, firstly, objectives driven. So, you know, what are you actually trying to achieve with the portfolio? Second one is diversity, and the third one is asset quality. So from an objectives point of view, and remembering the context that we're generally putting together portfolios for, you know, high net wealth individuals, generally sort of closer to the end of their working life. You know, wealthy people still have objectives though. So for us, it's all about understanding what that objective is. So are they trying to generate sufficient revenue over a period of time to meet their future living expenses, you know, the ability to buy bread, milk, rice, race cars, whatever it is that people spend their money on. So we're always trying to keep that objective in mind. So if you're a young person, you still need to keep the objective in mind in terms of putting your portfolio together. What's the purpose of the money? What's the use case at some point in time? When do you think you're going to need it? And make sure that your asset selection is in the context of what you're actually trying to achieve over a period of time. So the second piece is diversity. I'm a big one for diversity. I'm a big one for making sure that you're not generating all of your return the same way, and that you're not taking all of the risk, all of the same risks with all of your money. So I'm a big one for making sure that, when you kind of draw the pie graph, you've got something other than, large cap equities, or you've got something other than tech, or you've got something other than Bitcoin in your portfolio. But I think the biggest one overall is asset quality. Your ability to pick unicorns, to be honest, is going to be limited. Keep the punting for the bookies and for your sports bet account or for your tab account. Buy stuff that has genuine asset quality attached to it. So if you're buying equities, good competitive advantages, good cash flow, great balance sheets, good asset backing, etc. If you are, if you've got a smaller pot of money, making sure that you're buying good quality portfolios of investments and good quality, broad-based ETFs, so that you can start to accumulate the wealth over a period of time. So be diverse, buy good quality things. Try and limit your winner picking over, because you just won't. And if you pick one, you're not likely to pick two. And make sure you're investing based upon your long-term or even your medium-term objectives or the purpose of the money.
Yeah, I like that. I think when we were discussing you coming and speaking at FinFest, in one of your emails, it's just a one-liner, and you said, all I want to talk about is buying good quality and buying it often, or something along those lines.
Yeah,
and it's
right.
just like, wow, that's just such a simple strategy.
Yeah. I often say to clients that we have three fundamental things that we want to tick the boxes on in terms of, the assets that we buy. One, we want the assets to be producing revenue for them. We want the assets to be producing income, or at least have the ability to generate revenue over a period of time. Secondly, we don't want to blow up the capital. So, we don't want to be buying things that have got the, high risk of impairment. I look at risk very differently to what some people do. Some people look at risk in terms of asset allocation and growth assets and, income assets or defensive assets. I don't look at it that way. I look at risk in terms of the risk of impairment. So not so much the risk of it going up and down, but the risk of it actually turning to dust. I take the view that large cap defensive equities are actually a defensive asset. Yeah, they change in value, but they're going to be there tomorrow. And, if they've got good balance sheets, they're well run, they've got good key competitive advantages, they're going to have an ability to generate revenue into the future. So buy those types of assets. And the third one is make sure that you're protecting the buying power of your money over time. You absolutely want to have more growth assets in your portfolio, because you want the revenue that asset can produce to increase over a period of time, not reduce. You want to make sure that, if you're buying any company or any portfolio, if it's generating $1 today in earnings, you want it to have the ability to generate $1.10 next year and $1.20 the year after and $1.30 the year after, so that you can protect the buying power of your money.
Yeah, love that.
You're seeing a range of clients, high net wealth and ultra high net wealth.
Must be nice.
Does the principles differ depending on how much money your clients have? And I guess coming down the income spectrum, when you're thinking about Bryce and I, do those same principles apply? Do we apply it differently?
Which bit of the spectrum are you guys on?
Not enough.
We're future high net wealth.
So certainly some of the key bits don't differ. The goals themselves will differ, and maybe the assets you've got access to differ. Often, unfortunately, in life, the more money you've got, the more opportunity you've got to invest in private assets or fixed and real assets, where the requirement to get in is bigger. But the principles themselves don't actually differ. That issue around making sure that you're buying into good quality assets over a period of time, you should continue to do that. And my counsel always is, if your pot is small, use the same principles, but invest in options that are suitable for that smaller pot of money. Don't cut up your pie too thin. Use good quality ETFs that have got good quality underlying assets, and have a material amount of your pot of investments in those good quality assets.
I think that's an important one, and a lot of people do ask us, like, how if I have $10,000 or $20,000, what is the split that I should be giving to some of those? Is it 20 different ETFs? Is it 50% in one, 50% in another? I know you can't probably answer that because it's sort of a personal thing, but how would you think about that?
Yeah, so I say, if you've got a small amount, and I guess when I think about small amount, it's, that kind of less than $100 or less than $50,000 to invest, you really don't want more than 2 or 3 lines of investments, to be honest, because you end up cutting up the pie too thin. You end up having immaterial exposures that, even if that immaterial exposure does 100%, it actually doesn't change your life. So if you've got 50 grand and you've got 20 lines of investments, simple maths tells you you've got about 2.5 grand or 2 grand or whatever in every investment. Even if that thing shoots the lights out, 2's turned into 4, it actually hasn't changed your life. You want a greater exposure or a more material exposure to normal, good quality lines of investments and allow efficient market theory to do its job over the medium to long term.
I can see Bryce tapping away on his computer. I think he might be selling a few lines of his investments right now.
Mate, you've got a lot more lines than me.
I do have a few too many lines as well, Charlie.
But that just means that apart from some core material stuff you've got, fundamentally you're punting. And yes, you'll have an investment thesis, and yes, you'll have a view on the particular individual stock, and you're actually doing that more out of interest than out of actual investing. You're doing that out of, wanting to see whether or not, it does well, as opposed to the actual investment thesis, which is all about, especially if you've got 50 or 70 grand, is really just about a savings plan.
Yeah, I love that. Yeah. That's awesome.
Well, Charlie, we're in a high inflation, rising interest rate environment at the moment. You can't escape it on the news and across our lives. When it comes to advising your clients and constructing portfolios for your clients, are you approaching it differently in 2023 to you were in 2021?
Yeah, so the principles themselves haven't changed around asset quality, diversity, etc. But I do think the way that we're sort of allocating monies or deploying monies probably has changed a little bit. Noting we're always trying to deploy based on those objectives and target overall return for investors. And we do actually do that. We actually say to investors, hey, over the medium to long term, we're trying to generate this type of return, and therefore we're going to take kind of this much risk based upon everyone's kind of individual kind of risk aversions and risk profile, etc. I think now there's probably greater value in those interest rate sensitive assets. So we've probably done more into credit style investments, debt style investments, things that are sort of interest rate sensitive. I think now in some ways the kind of return that you're getting from a bunch of those credit style investments is probably asymmetric to the risk. So, if you think about the fact that, where the cash rate is or where the bank bill swap rate is, if you can generate a margin over the bank bill swap rate now of 3 or 4 or 5 or 6%, you're actually generating kind of 9 or 10% returns, which is reasonably compelling for investors, especially investors with bigger pots of money. And you're probably taking less risk than what you had to previously to do that. Investment in some of that corporate credit, asset-backed credit, RMBS debt, non-construction property debt where the sponsor, I think the returns there are reasonably compelling. We're probably taking a view that we feel like rates will peak later this year at kind of 3.9. Maybe don't quote me on that. I think the consensus is a little lower than that. We maybe think that we're a bit more hawkish than that, I think.
Well, Phil Lowe didn't think rates would rise until 2024. So whatever you say, you're closer than him.
We probably think rates will peak at the end of this year, to be honest. And, certainly Cameron, our sort of senior analyst, is sort of saying 3.9. I think consensus is 3.75. So I think when you're getting returns of 4 to 6% above bank bill swap rate, returns are fairly compelling. We went pretty hard last year and the year before at real assets. We did a lot of industrial property stuff. We did a lot of infrastructure. I would say that we've certainly backed off exposure to, or new exposure. We're really happy with the exposures we've got, especially in that kind of industrial asset space where, there's kind of that real rental power that exists because you've got leases which are subject to CPI increases. So you're kind of getting this kind of passing on of the cost of the increased cost. So clients are generating good yields, but the value in that sector has certainly come out because cap rates kind of contracted really far or came down really far, and then you've got construction costs which have gone up. So lots of the values come out. So we're probably doing less of that than we were, in 21 and 22. We were still a major buyer of equities, especially into the weakness. Mid last year, we're doing a lot less in terms of new equity purchases. And in fact, in our sort of 31 December investment reporting to clients, we took a little bit off the table and we took a bit of value. We saw markets kind of climb 10 or 12% towards the sort of back end of the year. So we took that opportunity to just take a little bit more cash. We probably haven't been a major buyer of international equities for about a year, and we're probably still not. We're probably waiting until we see what the next quarter earnings numbers look like. And we're actually not doing heaps at the moment. There's a bit of private stuff around that we're doing, where we've got new clients coming to us. We're taking small equity allocations, but we're sitting on our hands. We're probably waiting a little bit to see what happens with the earnings numbers and whether or not we see this kind of cost of capital flow through into earnings numbers and into balance sheets. The likelihood is some of that's probably priced in, but I feel like the risk of waiting and the risk of maybe getting it wrong is a better risk to take than kind of bundling all the money in and then feeling really sad that we weren't kind of a bit more disciplined about sort of being a bit more patient. We're probably staying away from REITs. I'm not a big fan of the REITs anyway. I think they just basically act like investment banks really. But remember that the REITs generally just are making their money on an arbitrage between the asset and the earnings, and the cost of debt's going to go up. And if you have a look at all the periods of great instability, the REITs got smashed. So if you go back to GFC, they all fell 50 or 60% or whatever it is. So, and that really is just the risk of their ability to continue to generate that arbitrage over a period of time. So we feel like if we're going to take property exposure, we'll go and buy real assets kind of thing. So the one thing that we are looking hard for is secondary PE or secondary private equity. There's probably an opportunity given the dislocation that occurred sort of late last year. We're big fans of sort of private equity and private markets. The public market is kind of getting smaller. The private market is kind of getting bigger. A lot of that sort of, once upon a time, the only way to get a liquidity event was to take your private stuff to public. And, people were getting rewarded with really big multiples and what have you. That then kind of fell over as risk came off, et cetera, at the end of last year. So there's a number of really good quality managers out there that are probably available to everybody that are now going around and mopping up this stuff at kind of 40 and 50 cents in the dollar on what was previously available. So I think for small parts of big portfolios or small parts of any portfolio, there's an opportunity in that secondary private equity space.
Yeah, right.
So just to clarify, secondary private equity as opposed to primary private equity, is that just like the smaller players, or is that?
I think the definition is probably a little fluid, but the definition of the way that we think about it is where you've had private equity opportunities that have either had their kind of third or fourth round and are moving towards liquidity events, but now can't obtain that liquidity event because there's no depth in the market for them to be able to do it, or they've already gone to listing and they've seen a significant sort of re-rating of the value of the asset at that point. So
they then come off the boards.
Yeah.
So like Weber in the US and stuff like that.
Yeah. So that's a good example. There's a whole bunch of it, especially in Europe, where everybody was getting ready for listing, and then the kind of backside fell out of the market somewhat, and now they're all sitting there going, well, we want our liquidity event, we want to give our early investors some of their money back. We're no longer going to get 100 cents in the dollar, but 50 or 60 cents in the dollar is still probably 2x or 3x for a bunch of those guys. Private equity managers can kind of see the long-term value in the thesis of whatever the underlying investment is or whatever the company might be. So they're putting together syndicates and hordes of money to go out and kind of mop these things up and put portfolios together.
Yeah, right.
Fascinating.
So, Charlie, a question we answered on our tried to answer on our Get Started Investing show last week was, are savings accounts back?
Yeah, I think. Look, my view on cash, and it's probably not everyone's view on cash is just something that's waiting there to be spent, and cash is really just waiting to be invested into something more interesting or for you to go and buy a race car or something with it.
Charlie loves race cars. If you
Look, I think now returns certainly feel a little more compelling now, where your high interest bank account's generating 3.5 or 4 or whatever it is, and it's rewarding you for sticking money in there. The 4% kind of feels okay, and I think there's kind of some economic debate, or someone smarter than me is going to say, yeah, but the real return's actually negative because inflation's 5.
Yeah.
That's kind of, it's kind of right, but it's kind of, for short term, it's kind of rubbish, because the cost of bread and milk isn't actually going up that fast. So, it's not the worst place if you're a bit nervous about markets and you're waiting for weakness. Open a high interest cash account, put your $1,000 a month in there, allow it to accumulate until you've got a material amount and you feel good about markets or whatever the case may be. We, from an investment management perspective, are probably holding more cash now than we have for a long time. We're pretty cautious. We feel like there are definitely headwinds in markets. We do wonder whether we will see somewhat of a sell-off, come the next sort of reporting period. We've probably already started to see that a little bit with the banks. The demand for credit and stuff has certainly slowed, and the ability to get credit has slowed. So, and I think that might permeate through the market. So it's not the worst time to have some cash around, to be honest, and have some powder dry.
Yeah, the banks, I was about to say you got to feel sorry for Matt Common, but no, you don't have to feel sorry for him. But he delivers Commonwealth Bank's record half-yearly profit, and his stock sells off 5%. Yep. You'd have to look at the market and be like, what more can I do for you?
Yeah, I mean, the reality is that the outlook for the next 6 or 12 months is pretty somber. You've probably got this reasonable sort of fiscal cliff that exists for, fixed rate loans, etc. Because you've got to remember, there was a whole lot of people who bought, $1 million house at Kellyville 3 years ago, bought a $1.2 million house with $1 million of debt in Kellyville. They fixed their rate. It was 2.5%, which meant that they were paying $25,000 a year, and they're earning 100, so they're taking home 80 or whatever it is. 25 is going to the mortgage. The rest of it can pay for the HSV, the boat, and the kid, and the kids to have fun. That 25 out of old mate's 80 is suddenly going to become about 65. And so suddenly you've got real stress associated with that. And that scenario is going to permeate, in terms of people borrowing more money, consumption generally. It's a reasonably somber 12 months, I think, in terms of spending and in terms of what the banks are going to be able to lend out and what affordability looks like. And I think that's the reason for the sell-off and people taking a bit of profit and et cetera. So,
well, Charlie, let's take a quick break there. And when we come back, we want to talk about investing for kids. But first, a word from our sponsors.
We are speaking with Charlie Viola from Pitcher Partners as part of the Ask an Advisor series. But before we get back into it, a reminder that if you're interested in upskilling and learning more about valuation and how to apply it to your investing journey, then we currently have $100 off our Value Investor program. It's an online course developed in conjunction with Owen Raskovich that will take you through everything that you need to know about valuation. So use code MATES at checkout for $100 off. The link will be in the show notes. But Charlie, before we sort of sat down for this interview, you mentioned that you're now starting to see a lot of your clients' kids come to you with not the 7 to 10 million assets under management, but a slightly more relatable amount to Ren and I. The $10,000, $20,000, $30,000, $40,000 sort of chunk of money, and looking for your advice on how to start deploying that. So let's start with, what are some of the common questions that they are asking you?
Yes, it's a really common occurrence now, and I think as I get older, my clients get older. So,
yes.
And they're sort of coming to me and saying, my son and daughter has finished uni, has started working full time, they're well educated, like everybody is these days, mid-20s or whatever, and has some cash. What should they do with it? So, and I'll be honest, I've actually really grappled with this, because it's actually a really hard question to answer, because, how risk averse are they? How sad will they be if, the value falls? That 10 or 20 or 30 or 50 grand is all the money they've got in the world. They don't often see how much money mum and dad have got. They assume it because they live in a big house in Mossman and, went to a fancy school and had their education paid for. But that 50 grand is still the most important thing to them in their life. So, what happens if they change their mind at some point? So I really grapple with this, and it's actually a really difficult question to answer. The best way to kind of deal with monies like that is actually with that in mind, with the fact that life in your 20s is reasonably fluid and you will actually change your mind. So the way I approach it and what I tell everybody is that if you've got 20 or 30 or 40 grand to invest and you think that you've got a medium term or a medium to long term because, you're not looking to buy a house and, you want to continue to work and rent and, maybe go overseas or whatever it is, my view has tended to be construct your portfolio but put 50% of the money in. And then on a monthly basis for the next 6 or 12 months, put the rest of it in on a monthly basis. And then whatever it is that you're saving, $1,000 a month out of your salary or $1,500 a month out of your salary or $500, whatever, put that in as well. And the reason for doing that, and leave the other half in cash and then put it in over the 6 or 12 months. And the reason for doing that is because it just then gives you the opportunity. If you do change your mind, then you've only deployed half of it and you can change tact. If markets fall, you're only going to be half as sad, but then you've got the ability to kind of do the dollar cost averaging thing over a period of time. And it just allows you to kind of learn on the journey without all of the anxiety of making all of the investment at once. And it also allows you then to kind of at least see what's kind of going on with your portfolio, what's driving it, whether you like the mix of assets, whether you don't, and make small adjustments along the way. So, yeah, like I said, really simple, put half of it in, put the other half in, in over 6 or 12 months in even amounts, and just stick to the strategy of actually doing that. Because, it just
that's the hard part.
Yeah.
Yeah.
Just having the discipline to stick to it.
And then when you think about the pie chart and what's in there, what are some of the key asset classes? And, obviously we're not doing secondary PE as mid-20. Well, maybe you are. It must be awesome. Nice. Yeah. So, how are you constructing that pie chart?
Yeah, so again, you go back to the principles, right? So go back to the principles of don't cut up your pie too thin, make sure you're using good quality assets, keep your costs reasonably low. You don't want too many lines, you'll end up with transaction costs. So I'm of the view that if you've got 20 or 30 or 40 grand and you're putting in 20 of your 40 up front and then you're putting in, $3 grand a month or $2 grand a month or whatever it is to make up the difference over a period of time by, large cap, defensive, good quality ETFs, for a good portion of it, which covers domestic equities and international equities, and allow efficient market theory to take over time and let time be the determinant for the outcome over a period. Close your eyes a little bit to the volatility and just stick to the plan of sticking the money in every month. But broad-based, large cap, go and buy STW or VAS or go and buy IOO or VTS, the large cap, good quality things. I don't think you have to try and pick the winners. I don't think you've got to try and go and punt individual stocks because you'll get it wrong and it'll create anxiety. And it's not the purpose of the money. The purpose of the money is that savings plan piece, over a period. I think a reasonable mix between domestic and international equities makes absolute sense. And if you want, a small alternatives bent, make that the third line, but make it a smaller line than the other two. But again, it doesn't need to be more than 2 or 3 lines. It just doesn't. You don't need to go and try and buy a basket of stocks and beat the index, because what you're actually trying to do is create a disciplined savings plan over time.
I have a couple of mates who, they were starting theirs and they were fixated on the idea of the high dividend yield ETFs and thought that that's one way to sort of fast track the process of building wealth into the portfolio. What are your thoughts on that? Yeah,
no, if you actually have a look at those high yield ETFs, they've been a disaster. So, what are they? VHY, YMAX, they've been awful versus market. Remembering that if you just went out and bought the ASX 200, the yield's like 4.5%, 70% franking.
Exactly.
That's pretty high yield as it is, right?
Yeah.
Just go and buy normal things. Don't try and outsmart the market. Don't try and be smarter than everybody else. Just buy that good quality stuff. Because remembering all that, those high yield or those high yielding dividends do is go and find companies that pay out more than 100% or very close to 100% of their earnings, which actually compromises the future growth over a period of time. So I really take the kind of the KISS principle on this stuff. Keep it as simple as possible. And then at least then that if we're starting to see greater strength in the economy and markets go up, you're going to benefit from that. And if we do see periods of weakness, well, you're buying in every month anyway, so you're getting the advantage of the dollar cost averaging.
Now, can I change a variable in there? The scenario we've been talking about is people that aren't talking about buying a house in the shorter term, but I assume a lot of mid-late 20s people are looking at the housing market at the moment and saying this might become an opportunity. What if one of these clients' kids came and said, I've got this money, I've been saving it up, I want to know what to do with it. I would, if there's an opportunity in the next couple of years, would love to buy a house.
Yeah, and that's actually really difficult, right? So I think that anytime you introduce risk to the portfolio, you need to have a 3-year time horizon. I think anything less than that, you end up possibly having to change your objectives because, you're needing to wait until things recover, or you're taking more risk than what you otherwise wanted to take, to be honest. So I think anyone who has an objective of buying a house within the next kind of 12 or 18 months, I think we're back to the cash accounts, to be honest, and getting sort of 3 or 4%, or seeking out credit style investments where you're not going to see greater kind of, volatility in terms of pricing. I think where you can sort of push it out more than 2 or 3 years, you can absolutely do the dollar cost averaging because you're going to kind of get a little bit protected by, and it probably cements the point even further about kind of blending, like buying your money in over a period of time and blending it in over time so that, if the house comes up, you can kind of change tact, or you're kind of getting that kind of blended in over a period. So again, come back to what the objectives, those key principles that we talked about early. What's the objective of this money? If the objective is to never see it change in value, then don't put it at risk. Because, I think we've all seen those tables that say that, equities have gone down for a 1-year investment, on 25% of occasions, but over a 5-year period, like virtually never, right?
Yeah.
So, you have to keep that principle in mind when you're making investments.
Yeah, that's actually a really good point. Where should I put my emergency account?
Is that the one you're hiding from your wife?
It's not enough in there to hide.
So, Charlie, one more question on kids. There's a lot of people in the Equity Mates community, Bryce excluded at this point, who are having kids, have young kids, or are thinking about it. And, they didn't learn about investing growing up, but they've been listening to Equity Mates and get started investing and they're hooked and they want to set their kids up. Do you have younger clients that come to you and ask similar questions?
We actually probably have a lot of people doing it for grandkids, actually. So where they're, and I think once upon a time there were probably things like education funds, which were effectively, sort of tax-paid investment bonds, etc. But they're really expensive and a bit ugly, and the investment options aren't great. Again, I have a really simplistic view on this. If you wanted to put money in for kids or grandkids and you really just wanted to, sort of stick all the money they get for birthdays and Christmases or whatever in there, or you wanted to put, $300 a month or whatever, just go and buy a really simple ETF and just allow it to continue to accumulate, or go and put it in a broad-based kind of managed fund where, you just allow it to accumulate over a period of time and just keep the discipline up of, almost the set and forget, and just, again, allow time to be that determinant. I made the comment before that, if over 1 year you see volatility, over 5 you've only ever seen positive returns, and over 10 you see really good returns. Yeah. And remembering, if you're investing for a 3-year-old, you really don't want them to have the money until they're 18. You've got 18 years of efficient market theory, or 15 years of efficient market theory.
Maybe 25 even.
Yeah.
I guess the second part of this question that we often hear is how, because, let's say maybe for some of your clients, like setting up a trust is more available, but
you just don't need the level of complexity around that. You can open a broker account with a designation for the child. So just mum or dad does it. It ends up being taxed at mum or dad's rates. There's not much you can do about that, but it doesn't wonderfully matter. Or open a managed fund. Just go to any managed fund provider. And just do it via the product with the child as the designation. And then with the child as the designation, you can kind of hand them that money when the statement comes through. Their name is in the designation, so it does feel like it's for them. Oh, yeah. It's just you as the parent have got control. You really don't need to go to the complexity of setting up a family trust for the purposes of having 50 grand in it over 10 years kind of thing, because the costs will kill you.
Ren, we have reached the end of the episode, but one of my biggest takeaways from this is we've got one of the most successful, top-rated advisors sitting here in the studio, and the key message is just keep it simple. and let time do the rest.
Yeah,
so,
yeah.
Charlie, I think some great messages out of today. It can often feel like once that there's more to it and that it doesn't need to be as complicated as people think it is.
I think we think about investing and we think about there's like a real gap between this ultra high net wealths and what we can do. But if Charlie's advising them to buy a couple of broad-based ETFs, only have a few lines on your portfolio, on your broker, it's something we can all do.
Exactly.
Just got to sell a few of our other lines now.
You've got to sell a lot of lines. Well, Charlie, thank you so much for joining us. If you've enjoyed today's episode with Charlie, we will continue our Ask an Advisor series throughout 2023. Keep an eye on the Facebook group as we reach out for questions for those episodes. But Charlie, as always, thank you so much for your time. We love it when you come on, and our community do as well. So thank you very much.
Thanks for having me.
Thanks, Charlie.
As always.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.